All right. Good morning, everybody. We've been waiting for it all week. Finally got it. The morning has come, and we want to be absolutely sure we're going to get what we think we're going to get. So it is Friday on a short week, first week of the new month, and we've been waiting on jobs data. It's been a big deal, but if you have been keeping your eye on dollar bond yields, treasuries, gilt, VIX, there's been some odd behavior out there, and it warrants a little bit of caution in front of this print. And this isn't even the big one, right? I've often said that with all of these places that we check in the morning, all of these calendars that we review every day, we don't have every economic event. This isn't an exhaustive list, right? There's many, many more that never land on here. And you may be thinking, yeah, well, it's probably just some, insignificant event and it doesn't warrant our attention. For an example, how much grain has left the harbor of New York? Who cares, right? But that's one of the economic events. You could see why they wouldn't list it on here. Really, nobody cares how much grain left the harbor of New York. But there's a lot of events that don't land on here that are important. Really, really big events like QRA. That never lands on here. Happens 4 times a year, and it's a really big deal. And you can check multiple sites, you can check multiple sources. You won't get them all. I've always argued you can never get them all. And that's just for the US. There's economic events that are happening all around the world in nations that have job numbers, bonds, treasury, yields, Fed speakers. We can't keep track of them all. And if you try, you'll just run in circles and you still won't get them, right? No matter how much effort you put into it. But one of the things that you can do is keep your eye on the clock because the government is lazy and stupid and it will run things on basic schedules, right? Half hour, new hour, sometimes on the quarter hour. Keeping your eye on the clock allows you to anticipate that we may get another surge in liquidity and volume. Now, setting that aside, there is a big event coming. We've been focused on today. Sure, yeah. There's another one on the 9th. You could ponder on that, right? What the heck is on the 9th? Well, we got the calendar. We can look ahead to next week. Not much of nothing. There is a revision coming that has been known for most of the year, and it is coming on the 9th. It's a jobs revision. So heads up, got another big one coming, and almost no retail has a clue that it's coming. A lot of the fixed income and smaller managed funds, assets under management, those guys that quote smart money, they're not smart. I'm telling you, I meet more and more of those people every day. They have no idea how to trade. They may know how to move assets around. They know how to manage one particular piece of the trading space, and they have a job to do with a very narrow focus that says, if this happens, do this. That's it. They are not traders. They're not smart money. They don't know that this is coming either, unless they are actually informed individuals. The point to that little rant is that markets don't like surprise, right? When there's an event that they didn't see coming, it tends to shock the market. Now, once they have a solution to whatever it is, then the markets settle down and solve the problem. No matter how bad it is, as long as they know what it is, they'll deal with it. See what we're going to get on the 9th. So look at your positions today. Consider what you could do to anticipate next week. I'm not saying negative, right? I'm not saying it's going to go down. I'm not saying it's going to go up. I'm saying we got something really big coming and the market doesn't see it. If they did, they would start positioning into it, and they're not positioning into it. So they don't know it's coming. But It's not like nobody knows because the bond market knows it's coming, right? There are informed traders and investors out there that are just standing aside and preparing it in different ways without necessarily hedging into the indexes. So watch out. I'm thinking strangles and straddles would be the cheapest, easiest, least complicated way to go, right? That way, if it goes up, you make money. If it goes down, you make money. If it sits sideways, well, you get squished like a grape. But those are easily defended trades too, right? And that makes it a good choice. So just a little heads up, September 9, that's the next rodeo. And it's not on anybody's radar yet. Looks a lot like yesterday with the Dow down, a dime and small caps up. But small caps ain't leading this morning. The NASDAQ is up 0.5%. Europe's up, and then Japan, not yet a quarter. So it's looking pretty good. The argument that I've had in the last week, seeing the moves in bonds and everything, is I mentioned gilt earlier in the week and said, hey, keep your eye what's going on in Europe over there. It's getting kind of shady. And yet Europe isn't the threat, right? And I agree with this. I was just reading on Gamma Lab. It's not Germany or Europe or the UK with that gilt market. It's Japan. It's always Japan. Keep your eye on Japan. Keep your eye on what's going on with Japan. That is the threat. Although they do make a good argument for why the gilt market is more vulnerable to the bond vigilantes. I think they made a really good argument, but it's still Japan. Keep your eye on Japan. It's US dollar Japan is the easiest way to do it. All it takes is a spark, right? And again, that's not some consideration that we could go down. We have right side tail risk. We are going to get the job numbers this morning. 8:30 is the event. Nothing bigger today is going to be as big as 8:30. The numbers look like they are in line. Nothing stands out. Once we're done with the morning session, we have an afternoon that's free unless we happen to get something out of the White House. Looks like he's going to be signing executive orders and making an announcement this afternoon. So, okay, well, there you go. We don't have a clear afternoon if he's going to be chipping teeth and being in front of the cameras this afternoon. That's 11, 1, and 3 o'clock. And then at 6, they're having dinner. Must be nice. No, actually, it's not. Happy Friday, guys. What a catch-22. The market is pricing in a rate cut because they think that jobs have gotten weak enough to warrant a cut. And yet, if jobs have gotten weak enough to warrant a cut, then the broader market backdrop is a weakening market that is steering in towards a recession. Now, nobody's using the R word or stagflation, right? Nobody's using either one of those words, but it just begs the question, right? If we are weakening enough that we actually need a cut, ain't that not good, right? How many double negative, triple negatives can we put into that thing? It ain't not good. And then what if they don't get it? So suppose the numbers come in today and they're not that bad. And then they say, we're not going to give you your rate cut that you've been pricing in and the market has gotten excited about and ripped up off of those lows for. So today we have the opportunity for a liquidity gap trade. I really like that trade. Looking at spot gamma, the call wall and the put wall both moved up. Now, they didn't move very much. but it's the first time the call wall has moved into a higher location. It had been where it was and lower, and then back where it was, and then lower, and then back where it was again, but it hadn't moved higher until now. So we finally got the move higher in the call wall, and the move was matched with the move with puts. So they both moved up at the same time. I consider that a bullish action. The thing is, it just moved, and we don't know if it's going to stick. We've seen all week the put wall went up, and then the next day it was down, and then it went back up, and then it went back down, and it didn't stick, right? So it didn't have any weight behind it. This is one day where they both moved. And what we want to see on Monday is, are they still where they moved? Or did they drop back down to where they were? So we want to put it on our radar that, hey, the put wall did move up. And that makes sense because we had that move in price yesterday. What an amazing grind higher, right? It just kept going and going. I love those kind of days, but I've always heard from traders on these days that they just got ran over. Why? Well, because the indexes are mean reverting. Most of the time we make a move one way and then we give it back the other way, right? And we close a little higher or we close a little lower, and that gives us our higher highs and our higher lows, or lower highs and lower lows. But we didn't mean revert. We just kept going, and it ran a lot of people over because, well, they kept thinking that the top was in and they were going to go down. And then, nope, we just kept going up. Now the top is in and we're going to go down. Nope, just kept going up. So if that happened to you yesterday, you must not have been there when I was talking about how to use quadrant lines to target the next level up, to identify where the next stopping point was, and how deep the pullback has to go to break the trend to call the reversal. Otherwise, you would target the next higher level, and then the next higher level, and the next higher level, and you just keep playing it. As long as it's going, you just keep going with it. Look out at the daily. We did get a new higher high. So we've got the higher lows, we've got the higher highs. The trend is still intact. The discussion on these 2 red days was that in that same statement, the trend is still intact. Don't let these 2 days turn you negative into the market and get you all bared up. So hopefully you didn't get all bared up on these 2 days, because here we are with, new highs. This isn't a I told you so, right? This is, pay attention to the things that we're talking about so that you can do it again later on your own, right? This entire stream is to teach you how to do this for yourself. So just like we did on the last pullback here, we can measure the pullback that we got, and we can project the next leg higher. 39 and 59. We can also identify the pullback. 64.92 cog line is the 786. All the moving averages are fanned out, pointed higher, got a nice angle to them. Price is above all of the moving averages, and it's above everything except the call wall. That's the only thing that's over our head. If you didn't see it at the start of the stream this morning, I was looking at this. This is net gamma that happened over our head. Now we closed at 64.88, and the flip point is 63.92 cog line. Is close enough, right? 2 points. Gimme. I'd take my 2 points from that. So it's 64.88. Puts us right in this zone here. See if I can change to a drawing tool without breaking anything. This is in our way, right? That big structure right there. Getting past that is going to be difficult, but we can get past it. The concern is if we get past it, this one here, because we can get trapped between these two and then get stuck, right? And that would be the rest of the month until we get into OPEX if that happens. Not necessarily a bad thing, right? That would stop us from going down, kind of, or at least, put some structure underneath us. But it can also act a bit like a gravity and draw us into that zone. And again, not necessarily a bad thing, right? My long-term accounts will be happy because, I want to see them sell off. All right, now I broke it. But it was real thin below that, right? Like there wasn't nothing there. And let's just go back here for a minute. There's this nice little write-up here on the side. And I like to show this because I don't like anybody to think I'm taking credit for something that's not mine, right? If I give you a point of view that's not my point of view, then at the bare minimum, I want to tell you, hey, it's not mine, right? And even better, if I can tell you whose it is, then I can give attribution where it belongs. They had some talk about the VIX. There it is from McElliott, right? Now I don't have subscriptions to McElliott and the Wall Street Journal and all. I don't have those subscriptions. I'm just here at Gamma Lab, and they are quoting McElliott and the Wall Street Journal and whatever, right? So they were talking about the VVIX, which is like the volatility of the volatility index. I know that sounds confusing, right? But just think of it like this. If I show you a SPY chart, I can put a implied vol indicator on the bottom of it, right? And then we can look at how much implied volatility does SPY have. Well, if I show you a VIX indicator, I can't put an implied vol indicator at the bottom of the VIX chart, right? That just wouldn't make any sense. So how do you know what the volatility is on the VIX if you can't use an implied volatility indicator on the VIX? They figured that out long ago. They developed the VVIX. So it's just the volatility of the volatility index. Okay. You want to pay particular attention to that thing, especially right now, because it's moving around. So I will end up cutting out this or just copying, pasting. Really, we don't cut nowadays. And I will post it in the chat for you guys to read. Not a big deal. Just get a little bit of insight on the volatility that is happening out there, so you get a feel for where they're getting their signals. Right? Because it's like I say a lot of times, you can focus on the thing that you want to trade, the NASDAQ, the ES, Apple, Google, whatever. But what you want to trade isn't moving in isolation by itself. There's nearly always another market that is influencing what you're trading. It can be 0-day option flows, bonds, treasury, dollar yields, commodities, something, VIX, and you want to know what that something happens to be this time, because it's always changing. We never know until we go look what's moving the market today. We're looking at 54,000 in the overnight volume. That's very similar to yesterday's 54,000. Both of those are lower on the week than what we had Monday, Tuesday, and Wednesday, which was 101 and 90. I think that 101 makes sense now in perspective, since we had no trading on Monday, or really a lack of trading on Monday, because futures did open a bit. And so it was just playing catch up, and that's why it was so high. That kind of puts that into perspective. They got caught up on their work on Tuesday and Wednesday, and now we're back into a normalized work schedule on Thursday and into Friday, because that's what we were running last week. 50s, a low 40 print, but otherwise we were running in the mid 50s. And then it got elevated. And it really just seems now, looking back, that it was elevated because they were just trying to get caught up in their work. I think we can all appreciate that, right? When you have the long weekend and then you got to come back and get caught back up again, you always got to pay the piper. If we make moves to the downside today, we got the volatility trigger and the put wall nearly on top of each other. 3, 10, 3-week volatility, put wall 20, and then 0 gamma way down here at 64.26. Below that, we got the 10-week. So we do have a lot of these ancillary products below us that we could bounce off of. But what the image that comes to mind is that old Rambo movie where he jumps off the cliff, right? And he falls through the pine trees and he's just smacking every branch on the way down. Yeah, that's the visual that I've got here. If we really start to break down that we're just going to smack our face on every one of those levels along the way, right? I know if you're young, you probably haven't seen that and have no idea what I'm talking about, but now you just have a movie that you can go watch. They are hedging this morning. This is not my opinion. I'm not guessing. I'm not pulling that out of thin air. They are hedging. Now, look, they're always hedged. They don't come trading in this market naked. These are additional hedges. Think about having house insurance, and then you hear that there's this massive hurricane headed right towards you, and landfall is going to be in 2 days. Not maybe, it's coming. So you call up your insurance broker and you tell them, I want to insure my house for hurricane damage just for a month, max coverage. And they say, well, you've already got insurance. Yeah, no, I want to double that. I want extra insurance just because. No reason in particular. You'll pay out the nose for it, but you can get it. And that's what they're doing here. They're adding additional insurance. And just like that house insurance, if the hurricane don't hit, you don't get a refund. They're not going to give you your money back just because the hurricane didn't come along. This is cost, and they won't get their money back. And they're willing to spend that money today because something is coming at 8:30 that has them nervous enough to buy extra insurance. And again, I'm not guessing or assuming. We know for a fact that they're buying extra insurance. This is the market make it move signal right there. Thinkorswim made it up right off the top of their head way back in the day when it was being developed by Tom Sosnoff and the crew. So you won't find that on other brokers, but you can see it on other brokers. What it's looking for, if you go into the options chain, it's looking right here at the implied volatility average. And any broker that has options is going to have that average, at least any decent broker. When the front average is higher than the next average out, you get a market maker move. If you want to read about that, you can search on Google, maybe on YouTube, but definitely on Google for market maker move, and you'll find articles that Schwab has, because they currently own Thinkorswim, that explain this in more detail. Unfortunately, they do not talk about futures in that article. Back in the day when TD Ameritrade owned this, they had like 12, 15 articles on this thing, and not once did they mention futures. But it's the same dynamics, right? So they are trading out of the money options in the ES in the front end for today. They're going to expire today. And because of that, it jacked the implied vol average of the front end options up high enough that we've generated a market maker move. What we can do with that, besides just having the tail looking at it and seeing that they are hedging, is that we can apply it to the daily range. So right now, the daily range is about 1%, 0.9, right? It's about 60 points. We can add 34 more points to that. So instead of the yellow lines being the days at range, we can actually go another 34 points higher or lower. And it would still be considered a normal day in the market, that we're not outsized, that we didn't move too far, and that it wouldn't owe us any sort of a pullback. That's what we can do with it. One of the things I like about having that label, we know what today is, right? We've been waiting on it all week. But what if it was just some regular Joe Schmo day like September 9, for an example, and we don't know anything about what's coming, and we see that when we log in? Well, that would get your attention, because then you'd be wondering, what the heck are they hedging for? There's nothing on the docket. But there must be something because they're hedging. Otherwise, they wouldn't do it. So I like it for multiple reasons. One is just that heads up, right? Especially when I was newer and I couldn't always keep track of what was next. To be fair, I still don't capture everything of what's next, right? There's always so many what next. So we had our missed daily pivot yesterday. We never did hit it. Tested that channel multiple times and it held. Got back above the weekly pivot, which I did call out yesterday when we got there. Digested around it for a bit. And then, of course, we just kept on trucking. And here we are today. Couple of things of note. When we open this far away from a daily pivot, the likelihood of reversal increases significantly. Now, I don't have any stats on that. I wish I did. I'm sure some coder out there could just start calculating the question of how far away is, quote, far enough to begin the consideration of a mean reversion. But every time I see us open this far away from a daily pivot, it increases my conviction that we're going to hit that pivot, right? Is it possible that we go the entire day without hitting it? Yes, absolutely. Price can do whatever it wants. But I'm more convicted that we will hit this pivot by the end of the day simply because of how far away we were when we opened from it. And then we tried to get further away, and well, that failed. And now we're setting lower highs and lower lows. We've got 6511 cog line, then the top of the channel, 6500, and then 6492 cog line or the daily floor pivot. When you open like that against the weekly, right? If we had opened like way up here on the weekly on a Monday or a Tuesday, that's another really good tell for a week that's likely stalled out. If you go back and look, that's a good one. I think the last time we opened that far away from the weekly, we held it until like Thursday, and then finally Friday we went down and tagged the weekly. But we were stalled out. We didn't really gain anything new on the week the last time we did it. So maybe it's the same thing today with the daily. We tried to get a little further, 6532 cog line, but we haven't been able to get anything else since then. We've got to get through this 830 print. And if that can get us higher than the high that we've already set, then it's game on. 65.50, maybe even, 66 if we get the exuberance behind it. More likely, however, is that we take out this floor pivot and we stay within yesterday's range. So we were inside day breakout. The idea would be that we come back inside the box and that we just close for the week inside the box. It would still be a good week, all things considered, right? The bobbing heads on TV would be talking about how we made highs again and the market's, still strong and blah, blah, blah. And everybody'd be happy on the week. That would still give us a close above the 20 if we stay inside of yesterday's price. We'll see. It is worth checking because of how far away we are, where the SNR levels are for the day. If we've already made R1, no, we didn't even hit R1. Yesterday was so wide that it made today's levels expand greatly, especially to the upside. You can see how the bottom down here, S3 of today and S3 of yesterday, they're almost equal to each other. And yet, look how far apart the floor pivots are, and look to the upside how far the R3 is compared to yesterday's R3. There is an R1 S2, and that would give us a breakdown and put us at 64.32 cog line by the end of the day. That'd be basically Wednesday's low. It's not bad, Wednesday's low. That would be below the 20-period daily moving average, though. All right, now I did point out last week when we started to actually put some work in up here that it was the first time in a while that we actually saw sellers instead of just exhausted buyers, right? You guys remember that? We were talking about it last week, how, especially on a week-to-week basis, but also on a day-to-day basis, that the buyers were just exhausted at the highs and fading away rather than seeing sellers come in until last week. We had sellers waiting up here and hammered it back down. Well, we made it through that level, and at least on this time frame, we can see a little bump from the sellers, but it doesn't seem like much, at least from here. Going to be watching this point of control today to see if it gets moved up more in line with these guys, because it is a lot lower than the rest, right? We've talked about how they're not going to line up perfectly, but that's a little too low. It's nice if you think about it. It filled in this hole. So, okay, great. The hole is filled, but I still don't want to see that point of control close there. It'd be better if we got it brought up into something above 60. From 60 to, say, 80 to 85. That'd be a nice 20-point area. Put it in that zone, we'll be better off. Ten-day, 30-minute volume profile and TPO. The TPO still looks reasonably decent. Point of control on both of those lined up nice. The candles that made the current point of control won't be challenged until into next week. So throughout the week, next week, we're going to be looking to see it move up into the mid 80s. And then from there, it's hard to say what's going to happen after that. Maybe it comes up into this 65.15 area. Maybe. But we are outside of the value area, and we are a considerable distance from that point of control, 64.70. We took the VPOC off the table from yesterday. That's the 65.18. Been there for a while. So we're done with that one. And we got a new VPOC. So now we're stacking them up nice and neat underneath us. I'm going to set mine onto a round number, but if you want to use, the ticks, go ahead. Let's try 69. It might be a little better. It's basically 70 anyways. But yeah, that's good enough. So if you want to zoom in and put it right on the line, you do you. Any move to the downside, we're going to have to work through these levels, branches that we're going to fall through at some point. And the distribution yesterday is really nasty, but you can see where they came in. That's a high level, it's a high level, that's a high level. We didn't spend a lot of time there to have that level of volume there. We spent more time here and we didn't have as much. Spent quite a bit of time here and still didn't have as much, right? So we were spending less time at each of these locations. This is where we spent a lot and then less and less. And yet the volume was getting greater and greater and greater. lot of time spent right here. Still wasn't the point of control though, because we spent, all night down here. Another 20 minutes, and it's very likely that that point of control would have moved up. I point this out because the point of control is nice, right? It takes all the thought out of the work, and you don't have to do anything. But if you're going to mark levels out, give some consideration to what you have on the table, not just where that point of control is, right? You can look back and realize, hey, that was a really big level. 6511 cog line. Imagine that. We talk about those levels all the time, and people ask, what's so important about those levels? You just get a lot of trades there. It's a key level to pay particular attention to. So I don't need to mark that high volume node. I'm already looking at 6511 cog line. But then you've got the other one down here. That's a high volume node. Oh, that's 6500. Yeah, that should already be on your radar. Got another one right here. I know it's hard to see because it's right on the value area high, right there. What's that? 6492 cog line. Yep, no, I'm already marking that one out too. Then there's one here, 6485, basically, right? So that would be a one worth marking out. It's the only one that stands out that isn't a part of a cog line or an options level. And then this morning, we've got a really nice distribution. This is almost classic distribution. The D-shaped portfolio with the central value area and the point of control within it lined up nicely. A little bit of a discrepancy between the TPO, which is the blue profile, and the volume profile, which is the green one. This zone here is less than this one here. The difference between these two, the way that I like to explain it, which isn't exactly technically true, but it works. Just think of the blue one as how many trades took place at that price, while the green one is how much volume was in those trades at that price. And while that's not exactly accurate, it's the easiest way to explain it to somebody to wrap their head around it. So we have a preview of next week's range. It's not set in stone yet. We always consider what next week looks like, but until Monday, we don't know for sure. And we got a couple problems with what I just did. One, this is a short week, the week that we have right now. And we can't really compare a short week to next week because, well, next week's a 5-day week. These ranges have two things in common: how much time and then how much volatility. So let's compare next week to the last time we had a 5-day week, and that would be last week, right? So last week it was narrower. Let's just do it this way. This is what we've got projected for next week, and we can compare it to the week before. Next week is narrow. Big events are volatility suppressing. FOMC, CPI, non-farm payrolls, they are volatility suppressing. So the range will be narrower if we have a big event on the horizon. I know that may seem counterintuitive. The first time somebody told me that FOMC was volatility suppressing, I thought they were crazy. Have you ever seen price move on FOMC day? It's big, violent moves and runs around all over the place. But what they're referencing is the days that come ahead of that event, where we very often go sideways waiting on the data. Yeah, Winfield Drox, it's the market maker move, the MMM. So next week is narrower in scope and range than the last full 5-day week that we've had. And that implies that there's a big event on the horizon for next week. We don't have to necessarily know what it is, but it gives us a bit of a heads up when we find a narrower range week. And it's not set in stone yet. So throughout the day today, price is going to move. So that gray line there in the middle is going to move. And the wings, the green and the red line, are going to shift up and down throughout the day. After 4:15 tonight, it'll all lock into place, just like all these previous lines. And then we'll have next week's range. So when we come in on Monday, we're going to re-examine it again. One thing I like to do is just leave this box here. This is what the range was during the briefing. We'll see what it is when we come back in on Monday, how much it increased or decreased. We are back above the 10-day. We can see that looking at this indicator. We're still in the zone, though, right? This is the range that we tend to hover in. We got to get out of that. But it's healthy. There's nothing wrong with our positioning. We're not overbought. Even that move yesterday, looking at it, you may think, wow, that was such a big move yesterday. Now we're going to mean revert because we went so far. This says we didn't go too far. We're not overbought. We're not overextended. It does not owe us any sort of mean reversion or pullback. Least squared method, dot plot statistics, nothing says that it owes us a move back on any consideration that we traveled too far yesterday. That's what I built this indicator for, is those big move days to be able to look back and ask, did we move too far? Now, I had somebody last week ask, how come I just don't use the Z-score? And yeah, I mean, don't get me wrong, the Z-score is good, but the math is a little different. And the Z-score is going to focus on the mean. There's always an argument about the mean. And I like to use what the market uses, right? The market uses the 10. Is it, scientifically accurate as the real mean? Nope, but it's good enough. Has been for years. Same with, the floor pivot. When it was designed, it was from pit traders who just needed some napkin math real quick of yesterday's lines and levels. They just used open, high, low, close, and over the years, it became the floor pivot. So I could use Z-score. It would be a more accurate representation of the mean, 100%. But I use the 10, and I like how I can swap from the 10-day to the 10-week. With the Z-score, you're the real mean of the weekly drastically different than the real mean of the daily, and you won't have the same flexibility as you do if you just use the 10-week and the 10-day, right? So that was a really good question, and you could use both, right? There's nothing wrong with getting a second opinion on, have we moved too far too fast? Never hurts. So look at this one and then look at the Z-score. Looking at the 10-week, though, we're just still repairing the moves that we had back in late July and August. Nothing wrong here at all. We're not overbought. We're not oversold. We're not overextended. It doesn't owe us anything. And this is just good, healthy location. We're sitting really nice. The things that are up or the things that are down this morning, we got less than 15 minutes before the data comes out, they won't matter, right? That's why I didn't rush to get to this point, because it doesn't matter what's up or what's down. We got to get through the data, and then we'll see what stays up or what stays down. So we can see that the Mag 7 up volume is up. China, Bitcoin, more China, chips are up, SMH, which is funny because the president just yet again last night at dinner threatened more tariffs on chips. But whatever, chips are up. China miners, gold miners are up. Uranium, solar, gold again. Tech, quantum is up. Nice. I'll take that. If the day gets sideways like it could possibly, I've been talking about big moves today, but it doesn't actually have to give us big moves. We could get one of those days where we get absolutely nothing and it just stalls out and goes sideways into the weekend. That's absolutely on the table. And if that happens, I think I'm going to go play over in quantum today. That's always a fun one to day trade. That one and airlines and yeah. So, it just gravitate towards what's getting flows. And if they're going to move quantum around, then sign me up. I'll go play over there. Yeah, Bitcoin, solar, uranium. That's not what you want to see if you're looking for an S&P NASDAQ rally day, because you don't want a rally day on pot stocks and solar and uranium. No, no, no. And pot stocks again underneath that, right? Nope, that ain't going to cut it. But I like that Bitcoin's leading and that we have chips up like that and that tech is right behind it. We've got the ingredients for a continuation of yesterday's rally, which, don't get me wrong, a lot of people expect that after a big rally day that that's it. You don't get another one 2 days in a row, but that's not true. We have history of making a big day and then the next day making another big day. It's happened before, it will happen again. So bear that in mind, right? That just because yesterday was a big up day doesn't mean that we can't get another big up day. Is it likely? Not really. No, it's less likely, but there is a history of it. And we have the ingredients for that to happen today because we've got chips and tech and Bitcoin all up in the pre-market. But we need to get that data and then see if they stay up. And that's going to be the trick. So watch the clock. You got 10 minutes. Watch for the liquidity gap candle. And of course, I'll take a picture anyways and put it in the chat to define what we have and what levels it gives us into the trading day. Everybody, be careful, be safe, have a good weekend. I'll see y'all next week.